Welcome to the Advanced Asset Management Advisors Mid-Quarter Commentary. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is Phil Volker, AAMA's Chief Investment Officer. Good morning, Phil.
Morning, Bob.
How are you?
I'm good.
Another fun day in the markets as we move on in 2026. We've had a lot of cross currents, some good things, some bad things, some unknown things going on, but clearly energy prices are affecting headline inflation. How do you see that transpiring?
Well, obviously the energy complex, as well as a lot of related commodity prices like helium and sulfur and fertilizer, urea, are up dramatically since the events in Iran. But really, and that's affecting all the inflationary numbers, but actually, some people may call it an inflationary event. The Fed may say, well, we're going to look past it because it's temporary. But I would say that we're more in an inflationary environment than just an event, because inflation has been building. We know that the Fed's behind their target for 5 years running now. And, they came close looking at the PCE numbers, the Supercore, the 3-month moving average was at 2.17 last June, which was almost there, but it steadily built through the year end to 366 and 425 in January before the conflict in Iran. And now it's 453. So you add on top of that the energy complex and related commodities, and it's not a pretty picture. The inflationary environment has been building over the last year. We've been steadfast in being against the Fed cutting rates, but they're in between a rock and a hard place right now.
Yeah, and we've seen a lot of inflation in food. I mean, you look at ground beef, what the average is about $6.90 a pound today, and 6 years ago it was $3.89 a pound. You look at prices of uncooked steak meat, $13 a pound, and that's up 70% since 2020. So, but when you look at all the food products, there's inflation everywhere, and it's, as you say, it's been going on for a while.
Yeah. So we've got confirmation across the board now, headline CPI, Supercore PCE, and even in April, we had non-oil import prices up 0.7 for the month. Technology components are up 13% year over year. So it's broad-based. It's an inflationary environment, and it's going to be a tough one, I think, for the Fed to navigate. The markets, the markets have already priced higher policy rates. The 2 years basically 40, 50 basis points above the Fed target. The whole curve is above the Fed's target right now. So the market is pricing in rate hikes, which just 3 months ago it was still pricing in Fed cuts, which of course we didn't agree to or agree with anyway. Not that we have a say in it, but it's going to be a tough environment. It's like, welcome to your new job, Mr. Warsh. Step into the fire with us. And, as we saw in his hearings, confirmation hearings, the Congress was all over him about how much he had promised to lower rates. And of course, he denied that. Now he's certainly not in a position to cut rates. But the interesting thing also is that he's long been a proponent of reducing the Fed balance sheet more aggressively than the Fed has, which we'll get better read on where he stands here over the next month, certainly at the first meeting in June. But if he does come out and make any speeches between now and then, we may get a little bit better handle on where he's coming from. Right now, it's sort of an unknown.
Yeah. And what the 30-year government treasury bond went over 5% this week. So,
yep, 512 this morning.
And what the old high was 517 back in 2023. So, it could go a fair amount higher. That's for sure.
Yeah. Yep. So that, the whole interest rate complex continues to support our position in our fixed income portfolios of very short term, 1 to 3 year kind of thing, very high quality. And I don't see that changing in the near term.
Let's move on to the recent market strength we've had, and stocks have rebounded a lot since they declined after the start of the war in Iran. What do you think about the rebound and just how healthy is this?
Well, if we look at the strength into October of last year, it was led by Mag 7 technology, et cetera. They sort of topped out. And in fact, in December, January, we saw a rebound or a broadening of the market into other sectors. But that's gone away. The unweighted average is hitting new lows on a relative basis. It's not made a new high yet. So you've got the S&P being led by, once again, a very concentrated segment. In fact, over the last week, as the S&P's been making new highs on any given day, there's been more new lows recorded than new highs within the S&P 500. So this last move has put it's actually even within the technology sector, it's been led by semiconductors. Semiconductors are now almost half of the technology sector and over 16% of the total market cap. So, it's even more concentrated today than it had been at any time during the strength of the market the last few years.
That's interesting. And what I think the S&P is now about 8.5% above its 50-day moving average, but there's only 47% of the stocks in that index are above their 50-day moving average. So it's
very narrow.
Narrow, that's for sure. When you take a look at the markets, how would you describe our positioning today on the equity side?
Well, it's very similar to what it has been, and that is, we have 20 to 25% exposure to technology underneath what the market exposure is, about 30 now, probably over 30, and diversified heavily into some defensive sectors, healthcare, staples, a little bit in utilities. But the underlying theme is still one of quality, balance sheet quality, because the operating environment today, I think, demands quality in the equity market. It's interesting that the hyperscalers are starting to spend the projected this year over 100% of their cash flow, so their free cash flow will go negative, and they're starting to borrow money as well. So some of the balance sheets of the Mag 7 are being eroded from a quality standpoint. So it makes sense to stay high in quality. The market at 22 times forward earnings is expensive. It's not back to its high. It was as high as 25 in the last year. So what has happened is earnings forecasts have grown dramatically. This year's numbers are projected growth has increased by about 10 percentage points since March. So there's been this huge uptick in forecasted earnings. And it's interesting if you look at some of the operating margins that implies. We're seeing the S&P 500 16% operating margin last year, projected to go to 19 and then eventually 21 as we get into 2027. So a 30% increase. The Mag 7 going from 27 to 32. The other 493 in the S&P 500, get this, going from a 13% operating margin to 19. So a 50% increase. Then you look at small cap 600 index going from 6% to 12, a doubling of operating margins, and the semiconductor index going from 22 to 45. So just a bit more than a double. So, prices are relatively expensive, but the earnings growth numbers are getting a little bit optimistic and require, these margins being met, which has never happened before. These kind of increases in operating margins have just never happened. So there's risk in the earnings, which means risk in the stock market. Could they make the numbers? Absolutely. But it's a lofty goal at this point. So again, diversified, high quality is the name of the game for equity portfolios.
Well, thanks for your insights today. Again, this is our mid-quarter commentary, and if any of our advisors listening have any questions or would like to talk about our portfolios, you can contact us at the locations below, and we will see you at the next quarterly commentary. Thanks, Phil.
You're welcome. Thank you.